right, you ready?
Got it.
Cool. All right. Hello, everyone. My name is Rick Albert, real estate broker associate with American Real Estate, as well as a house hacking real estate investor here in Los Angeles. And I'm here with Mr. Jonathan Kim. Go ahead and introduce yourself.
This is John Kim at Guaranteed Rate, loan officer, work closely with Rick.
Yeah. So what we do, we like to do this once a quarter. In case you haven't seen our previous ones, we've been doing this now for what, 2 years?
Yeah.
Just about. And we kind of talk about what's going on in each other's worlds. And then we always try to pull some stuff that's going on in the news. So thank you guys for watching. Let's go and get started. So I'll start with asking the questions. What the frick is going on with the interest rates?
So interest rates are going absolutely nuts for like the past couple of weeks. But finally they kind of settled out around mid fives right now for like a conforming loan, just an average like 20% down normal conforming loan. But they were at one point like above six. But then, with the Fed announcements, everybody was getting scared about inflation, all-time low unemployment. The Fed had to raise rates, 3/4 of a rate hike in order to kind of get inflation under control, which today they announced that they beat expectations on getting inflation kind of back under control, even though it's still very, very high. But yeah, for a little bit for now, like we've been in about a week now, we've been selling around 5.5, which is still in the grand scheme of things, like all-time lows in the history of the United States. People I think were getting a little scared in terms of, technically we're in a recession now. Because we have a contraction of, the GDP in the 2 quarters. So that's where we're at. People were scared, but it seems like all of a sudden people have kind of come out of their shells and are starting to do business as usual.
Nice. Okay. So, because the problem with the rising interest rates, I mean, flat out, I had clients that were pre-approved and now they're totally knocked out, like just completely knocked out. Because when they got pre-approved, they were, it's almost seems like their values doubled with, or basically cut in half, I should say, right? They were qualified for a couple, 400,000. Now they're qualified for like 200,000. So what can first-time home buyers do right now?
Yeah, I think the thing about it is that first-time home buyers, like, you shouldn't get discouraged about what's going on. Like, it's the long run that really matters. The interest rates, day to day, week to week, are not going to really fluctuate that much at the end of the day. But staying in the game, staying positive, and I think, you know, saving as much money as possible, and even getting co-signers, getting gifts. These things are very common. We just have a file where someone got a $250,000 gift from their parents, right? So there's no shame in it. Maybe there was a stigma about it, maybe previously in other years, but with home prices being so high, especially in LA County, everybody needs some help around now. It doesn't seem like home prices are decreasing, but you'll probably be, better expert at me than me about that. So we should continue to expect in the long run, right? Rates to rise, prices to rise, just not as dramatically as we thought they were. So no reason to go in panic mode about it. Getting help is always an option. There are down payment assistance programs. If to be honest with you, I feel like anytime I've run into the situation where somebody wants DPA, you are actually paying a lot more at the end of the day using a DPA, and usually there's a lot of
DPA,
restrictions.
down payment assistance.
Down payment assistance, sorry. Yeah, and it's more expensive in the long run, and then there's income restrictions as well. So, or loan limit restrictions. So usually in LA County, I feel like it's still kind of unaffordable to do a DPA, and it's not in your best interest really. But getting help from family or friends is probably the best bet in my estimation.
Yeah, right. Because I mean, there's some people, unfortunately, they're just going to be priced out. Like it is what it is. And what I've told some people, like, well, how are first-time homebuyers supposed to get into it? It's like first-time homebuyers have been struggling for years. Because if it wasn't the interest rate, it was the home prices. If it wasn't even just the home prices, it was just the competition. So now, like you said, things have slowed down a little bit, but you still have high interest rate. Either way, first-time homeowners are having to get more and more creative.
Yeah, and it's a double-edged sword too, right? So, now we know that purchase prices are, probably still going to be increasing, but the amount of offers that we're putting on during COVID was just absolutely ridiculous. shotgunning multiple offers at the same time, knowing that probably only one of them will actually be in competition. I mean, it was just too nuts out there. I feel like now there is some sanity to the market. It's not necessarily a buyer's market. Maybe you can kind of expound upon that, but it's definitely not the seller's market that we had during COVID years.
Last year I had a client every weekend. They either I was with them or they went to open houses, and then they made me a list of properties they wanted to write offers on. So I remember one weekend, I think we sent out like 10 offers. Following weekend, it was like 6 offers.
Wow.
Right. And a lot of agents would advise their buyers not to do that. It's like, well, what if more than one gets accepted? It's like, well, then you got to back out. And then listing agents don't like it. It's like, well, you're trying to get more than one property. It's like, what am I supposed to do? Right. Like we sent out 16 offers. I think at that time, none of them stuck.
Well, yeah, and people were getting super aggressive to the point of where it was very dangerous, right?
Yeah.
They were lifting loan contingencies, appraisal contingencies, shorting escrows to like ridiculous amount of times where, with that amount of volume at that time and shorter time frames for all the contracts going around, it really put a huge strain across the mortgage industry, which kind of now is pretty much gone away, right? I feel like people have learned their lesson. Like it's probably not in your best interest to put all your earnest money deposit, your EMD money at stake, just to beat out 30 other offers, right? It's probably not sound.
Yeah.
Buying a house is a complicated thing, and there's lots of things that there's a lot of due diligence that you should have before you commit to what accept.
Yeah. I'm trying to think if you compare it to last year, I think I had 2 buyers that did no appraisal contingencies. Knock on something. So far, every client that's ever done no appraisal contingency, we've gone to appraise.
Nice, yeah.
Yeah. So like I've been happy about that. But you're right. This time around, for first time home buyers, in some ways it's actually easier.
Yeah, I feel like that's the case too. Is it feels like when you're putting an offer in, the chances of getting accepted, the percentage is a lot higher than it was 2 years ago. Before it was like, oh, there's another one coming out, and there was nothing ever back. And some of them were just, emails back from listing agents be like, no, you just didn't even compete, and there was even no counters either, right?
Yeah.
And but now you're kind of seeing sellers kind of come around. You're seeing seller credits, and I think one of the creative things, and we touched upon this before, is that having either seller credits or having sellers pay the points, the closing costs, in order to lower that interest rate for the lender, and then it's a win-win for everyone.
Yeah, I agree. So the seller nets more money than doing the price reduction, and the buyer's payments are less.
Absolutely, yeah, and that's one of the creative things that I've seen kind of happen again and again and again, and it's a really smart thing, and it's both, the buyer seller relationship doesn't need to be close, but it doesn't mean adversarial either, right? Everybody's trying
Right.
to accomplish the same thing. So, two teams working together like that is really great teamwork.
I agree. What I told a lot of agents when I'm representing buyers or even sellers, like, look, this is a team effort. Like, nobody wins if the property doesn't sell.
Absolutely.
Right? Agents don't get paid, loan officers don't get paid, the seller doesn't get their property sold, the buyers don't get a place. So it's like we all kind of, this is not a I'm against you type thing.
Yeah, absolutely. I'll tell you one experience. Just a couple months ago, this HOA had a third party management team, and you have to have an HOA questionnaire to make sure the HOA is healthy. They just would not fill it out because they were afraid of liabilities. So we went to the listing agent and said, "Hey, listen, we can't get the loan through unless you answer how many months of reserves you guys have. We need some basic information." So because the listing agent had a relationship with the owners of the HOA, they bypassed that HOA management company and just got us what we needed. So that's one perfect example of how agents and lenders can work together in order to make a deal happen when there's roadblocks, tied to a specific transaction.
So besides having the seller or even the buyers, if they have the cash, buy down the interest rate, what are some other creative options for buyers?
You could, you can just put more money into maybe paying down the points. So basically, you're just putting money up front to say, hey, in order to reduce my rate from 5.5 to 5.25, that's always an option. Gifts, co-signers, those are still, have always been around. paying down credit card debt, not during only during escrow. Don't do it preemptively. That might actually lower your credit score, to be honest with you.
It's happened to me. I
Yeah,
was so pissed.
yeah, absolutely, yeah. So how the bureaus look at pay downs is kind of strange, right? Like, I guess there's reasons why your score would lower because they don't have enough credit history on you now. But paying off the small credit cards, some people have like I've seen like 10 different credit cards, but they all have like $20 balances on them. You can pay those off during escrow at the end of escrow, and then it'll get your debt to income ratio in line. So lenders are always tasked with making sure that you have a loan you can pay back in relation to your existing debt, right? So if your existing debt decreases, then the loan amount can increase because it's a one for one, basically. Every dollar debt you reduce, a dollar more you can borrow.
Right. That makes sense. So now switching over to sellers, or just homeowners, I should say, because sellers are looking to sell. But me included, last year you helped me with my refinance. But with the rising interest rates, should they be doing refinances right now? Should they be doing home equity lines of credit? Can you kind of explain what the difference is in like today's market?
Yeah, I would say that it depends upon what your goals are, right? So if you intend, so everybody is in a different place in their life. Some people, their kids are growing up and they need a downgrade. There's just too much house for two people, right? So they may just need to sell in order to get a smaller place. Some people may need to get a bigger place because they have kids coming. So they have an existing place, they need to add a room, anything like that. So it really depends upon what your situation is. At the end of the day, your needs are your needs, right? It's kind of independent upon what the interest rates are going on right now. These are life event things that have to happen, and those needs have to be fulfilled one way or the other. It's just a question of where are you at in your life and what are the cheapest options. If you need to add on, a HELOC would probably be a great idea. If you need more income, getting a HELOC to add a ADU might be an option. Doing a cash out refi to finance that as well is another option. But it all depends upon, hey, do you need all the money now? Do you need to spend it incrementally, or have a zero draw HELOC so you're not paying interest on money you're not using? I think the biggest thing that sellers have to understand now is that the COVID years are over. Sellers don't command the market the way they used to. I think everybody's kind of catching up to that fact. But at the end of the day, you're going to have to work with a buyer if you're going to sell.
Yeah, I think that I think you hit the nail on it. It's all about setting expectations. All right. I met with someone, she's thinking about selling her house, met her yesterday. She doesn't really want to sell, but she might have to, right? One of those life event type deals. And she's like, well, what if I sell now versus like 3 months or 6 months down the road? And I said, look, I can't predict the future. Right. On a practical basis, if I could predict the future, I'd be in the lottery business. Right. Like, why not? But you need to do what's right for you when it's the right time. I mean, I remember this was a while back. You and I helped a client. She bought a condo in Reseda. I looked up our emails when we first met, when the introduction was made. It was almost 2 years to the day that she bought.
Wow.
And she got a stellar deal, right? Because at the time, but that's the thing. I've had other clients, same thing. Waited years before they bought, waited years before they sell. And I tell them, like, look, you do what's right for you.
Absolutely. It's kind of like, getting a passport, right? You don't get a passport the week before you go out of the country. You get a passport weeks before, and you need to know that you're going out of the country maybe sometime in the future, right? I think, like you said, it's a life event situation. It's only do what you feel comfortable with based upon your life event, but I wouldn't really time it based upon market conditions, because market conditions are always going to change intraday, right? Every half day rates will change. But your life event, issues are going to be there in your face, and those are things that you can control. So, I think at the end of the day, we've talked about this before. Timing the market, I think, is bad for everyone, just because there's Harvard graduate MBA professionals who get it wrong, and that's what they do in their entire life, is to understand what the markets are doing, and they get it wrong like 50% of the time.
Yeah. Yeah, we also have to remember that it's not just timing in terms of interest rates, but also like buyers' taste, sellers' taste, right? So what did we learn? 4 bedrooms, really hot right now. They were hot last year and they seem to be pretty hot this year because people need that 4th bedroom for their home office. Before that wasn't as big of a deal,
Right.
right? So people's taste change, and that can also affect the value, how fast things sell, all of that, right? I'm telling a lot of clients, we have one in escrow right now, John and I are working on, where it's a 3 bedroom townhouse. It's like, that's perfect because as people get priced out of the single family market, they have to go somewhere and they need that bedroom count.
Absolutely. Yep.
So, what should we be now that we've talked about what happened last year, even though we're in August, the year's already over half over. We talked a little bit what's going on today where things are slowing down. From a mortgage perspective, what should we expect over the next 12 months?
Like I said, just what you said before, I don't have a crystal ball towards anything. But I think you have to think about the aggregate, about the long term. In the long term, rates are more than likely going to keep increasing. In the long term, prices are more than likely be increasing. The question is how dramatically?
Right.
Yeah, and I don't think that's where everybody is going to be different. I don't think it's going to be super dramatic. That's why I don't think it's probably in the best interest for anyone to wait. I don't think there's really any reason for anyone to wait at any given time unless you have a life event issue, right? If you know you're going to lose your job, that's probably not the time uh,
To buy
to
a
buy,
house.
right? Yeah, but if you're securing your job, or like if you know you're going to have a baby, or your kids are moving to college, these are things that are life event issues that you need to prepare for, now. And like you said, some of these journeys take 2+ years uh, to come out of. So, everybody's, has their own personal timeline, and nobody wants to rush anything or put yourself in a situation that you feel uncomfortable. However, I think in the long run, rates will increase.
Yeah, and that makes sense. So then we just have to plan for it. But the good news is when rates go up, historically, that does not mean prices go down. It just means a slowdown, which if you're, the investor mindset, first time home buyer, whatever, it's kind of like, well, now I actually have time to catch up for that down payment. Because I think that was kind of the biggest problem people had over the last couple of years is, okay, I've saved up my 30 grand, ready to buy. It's like, dude, prices have gone up. Now you need to save up 40 grand.
Yes,
Like
absolutely.
they're constantly chasing the market. So here it's like, okay, with prices slowing down, it allows you to catch up. But then you do have the opposite side, which is interest rates going up, but your wages aren't keeping up.
Exactly. It's about acceleration, right? It's not about
Mhm.
velocity. So the
Right.
acceleration is slowing down, but the velocity is probably gonna, stay the same. You hit it on the nail.
Right. So, okay. So last but not least, before you start asking me questions and we go into kind of the news segment, is for those that know, I do subscribe to MBS Highway. MBS Highway provides a lot of data based on current unemployment rates, the speed of building, and they kind of do predictions as far as how values are going to be over the next year and then cumulatively over the next 5 years. And we've definitely seen a slowdown. Historically, over the last couple of years, they've been saying it's between 6 to 7% over the next year. Now for LA County, they're saying 3.6% for the next year, but we're still at 29.34% for the next 5 years. And then Ventura County, which I'm becoming more and more of a fan of, because if people are getting priced out of one area, they have to go somewhere else. Ventura County is actually doing really well. They're anticipating almost 7.5% increase over the next year, and almost 40% over the next 5 years. So I want to get your take, knowing, okay, let's assume they're right? Because this is all predictions. So let's say 3.6% appreciation over the next year. Doesn't sound as exciting as it has been historically. Over the last 5 years, it's been almost 8.5. But what's kind of your take on it?
I think the whole thing about it is in general, right? I think the biggest mistake first-time home buyers make is they have emotional attachments, or they want it as a forever home, or it's got to have this pool or this barbecue set, right? It's much better to think of it as a business, right?
Mm.
If you think of your personal finances as a business and you ask yourself, is this going to be a good investment for me in the long term, right? Not the short term, not 6 months, not to a year, but if you have goals and plans, and I know, Rick, you do a lot of kind of this kind of coaching thing where, how to build wealth through real estate and buying a primary, living in it for a year, and eventually making that to an investment to buy a new primary. And then you can kind of like domino effect and jump the amount of properties that you have through long term investments in real estate. If you look at it that way, um, in general, those are, that's a great idea, right? If you're going to move to Ventura and, you're going to have that kind of appreciation, that's where people's wealth comes from, is through their real estate. It's not going to be through their 401k. It's not going to be through their stocks. It's going to be the real estate, because real estate, you're appreciating in two different ways, through the market and just you making your payment and reducing that principal on your loan every single month incrementally over the long term, right? And, people tend to move like every 7 years. So the amount of equity you build over that time frame is equity you otherwise wouldn't have if you just rented.
I 100% agree. And I think you also touched on something that not enough people are talking about, which is equity pay down, right? So let's say values did not change at all for the next year, but someone buys this year versus next year. The person who bought this year is automatically ahead because they've had a year of paying it down. They already have more equity than that person buying the following year. And then to your point, if interest rates go up, then that person's not only didn't get that equity, but they're also paying more for the same thing. That's
Absolutely.
really, right? So, and we're also not talking about the tax benefits of owning. Like there's a lot of benefits outside of just the appreciation, right? It's a
100%.
fixed cost, rents are going up, which we'll talk about. And it's just one of those things where it's like, you have to do what's right for you. And when you write your offers, or when you're listing your place for sale, be realistic on what you're comfortable with.
Absolutely.
Yeah, I think people tend to stretch themselves too thin, and then they wonder why they're in this spot. It's like, well, no kidding.
Yeah, and Rome wasn't built in a day, right? It's very rare a first-time home buyer ever gets their forever home. That's very highly unusual. Most people
Right.
have to go through a cycle of maybe, 2 to 3 homes in order to get to a place where they're like, oh, this place, can support, a four-person family. This place
Right.
is where I can see myself growing through, my kids through, middle school and high school too. So, nothing in this life that ever came easy was ever worth anything, right? So it's just like anything else. The more work you put into it over the long term and with long term goals is going to be the most secure way of building your wealth.
Yeah, I agree. I agree. So what questions do you have for me as we segue into the second part?
So yeah, it's interesting. I watch the market a little bit, not as much as you do. However, well, first off, we're in escrow in this one place, at a pocket in LA. You're big in pockets and about underappreciated areas, overappreciated areas. What do you think is going on in these pockets, and how do you think you can kind of strategize in order to maximize your purchase?
Yeah. So for those who don't know, my personal strategy is I tend to look at desirable areas and want to live just outside of it, right? Because as the desirable area gets basically too expensive, right? Then they have to go somewhere. And that's where I come in, right? Whether it's rents or whatever. And there's nothing wrong with the desirable areas, right? One of my favorite neighborhoods is Pacific Palisades. But if I don't have $4 million to spend, then I have to go somewhere else, right? And so what are we seeing? We're seeing good appreciation because they don't know where else to go. I sold a house earlier this year in Chatsworth, a 2-bedroom house. We still got 5 offers, right? It was a 2-bedroom house.
Right.
But people know that if they want to be in that area, and it was listed under 800, which is below probably the median average for LA right now, they don't have a lot of options. But it's still going to be cheaper than honestly parts of Northridge or even going to Woodland Hills, that sort of deal, right? Like I have a listing coming up in Tarzana, right? So in Tarzana, what I like about it is it's definitely a good alternative for the Encinos, the Sherman Oaks, the Studio Cities, and even parts of Woodland Hills. So as all these places get really high in prices, they all kind of converge. This is actually my personal residence at one point. This was my condo I bought in 2015, right? And I bought it for $225,000. And I put money into it over the years and renovated. And look, I'm going to put it on the market. If I don't get my price, then I'll put it up for rent. Right? In negotiations, the person who carries the lease has the most leverage. So if someone wants to lowball me, go for it. I'm not going to accept it because I don't have to sell.
Right.
But I'm also not going to price it to where it's super unrealistic. It'll actually be one of the lowest priced 2-bed, 2 baths in all Tarzana. So it's not like I'm like shooting for the moon, but you're right. In terms of these pockets, they're generally doing well because if not only people priced out because of literally the price, but now because of interest rates. Right. So yeah, I used to be able to afford to buy $1 million home in one neighborhood, but with the rising interest rates, that $1 million qualification just dropped down to $950. But you can't buy anything for $950. Therefore, you have to go somewhere else.
So speaking of going to someplace else, in terms of inventory, that's one of the things that we've seen that's kind of been a lot different during the COVID years. Can you kind of expound upon inventories between single families and condos?
Yeah. So generally speaking, inventory is going up, right? Because you had sellers that were selling before the interest rates went up, but then their pool of buyers just got smaller. But overall, things are still low, right? The month supply right now, I have it right in front of me. Okay, LA County, 2.5 months. So that means if no new homes came to the market, both condos, single family, it would take 2.5 months for everything to sell. Anything below 6 months is considered to be a seller's market. That's really fast, right? On average. But what's super interesting, and that's been on the rise, right? That's been going up. At one point, it was below like 2, right? Especially in kind of the height of the market. But what's interesting is the days on market for LA County haven't changed that much. It's still at about 13 days.
Oh, wow.
Which is like, okay, so that doesn't quite make sense. Inventory is going up, but the average over the last 3 months has been anywhere from 10 to 13 days. That's still really fast.
Yeah.
So I think that what that tells me is that people are, even though inventory is going up, people are getting more realistic as to pricing, but then also the buyer demand is still there. Right?
Good.
Buyers are
Yeah.
still out there.
So, also too, lenders saw a huge increase in licensing during the pandemic. So did real estate agents. Have you seen a degradation in the quality of negotiations that you've come across?
Yeah. So for those watching, the idea is like there's more and more people signing up to become realtors, more people signing up to become loan officers. And the reality is because they're seeing the rising prices, they're seeing the $1 million listing shows and be like, I want that. They see, oh, I can sell a $2 million home and I make 50 grand. But what they don't realize is out of that 50 grand, part of that goes towards the brokerage, right? So now your 50 grand just turned into, 40-ish grand. But then you have taxes, then you have your expenses. Like that tends to dwindle down really, really fast. And on top of that, the business actually has generally gotten harder, right? It's like, it's harder to convert people to sell because it's tough for people to sell, right? I locked in, thanks to your help and guidance, 2.875%. And at one point we locked in higher, but you're like, no, go ahead and break the lock. Well, it'll be fine.
Right.
But it's like, how am I supposed to move? So if you're a realtor new to the business, you're door knocking, you're calling potential sellers, and they're all going to be like, I can't afford to move. So it's hard to get listings in that world. Then it's like, it's easy to find buyers. Those are easy, but then you still have the qualifying issues. You still have finding, still somewhat multiple offers. I have a client, we just started writing offers, and so far we've written 2 offers. Both times we have multiple offers. Like it's still happening.
Right.
So it's actually much tougher than people realize. But people still want to sign up because they think they can be different. They're like, oh no, that won't happen to me. So in terms of quality, yes. I have noticed in a lot of cases where they don't know all the nuances because, and I don't know how it is in the mortgage industry, but I'm imagining it's the same. The questions on the exam aren't practical. The stuff on the exam are like, how many square feet are in a township? I don't know. Like, I don't remember. I know there's 4 steps to convert a mobile home into a single family, but it's like, in what world, like, am I personally going to do that? That's just not my niche. So I am coming across a lot of buyers agents and listing agents who generally don't know what they're doing. And they're in over their heads. And frankly, I love it because it allows my buyers and sellers to get a better deal.
Yeah, in my experience, you think really, really hard in really different scenarios and really creative ways to try to meld the goal of what that buyer is trying to do. Because I feel like most of the time you work with buyers who are trying to build long-term wealth over a series of real estate transactions, and how loans can affect that is pretty tremendous based upon timing and what your strategy is in terms of, are you going to sell, are you going to retain, are you going to rent it out, are you going to make a second home, things like that. Are you going to buy a 3 to 4 unit? Are you going to buy a 2 unit? Are you going to just buy a single family or a condo? How these things will jeopardize or domino effect later transactions as well.
Right. Yeah. I mean, it's very common for people to go through, burn a couple agents before they find the right one. And that's exactly why, right? These newer agents, they don't know how to get creative. And because of that, their clients' offers aren't getting accepted. Or I was reading in a forum, this is another part of the country, where she's like, I wanted to schedule a showing. So I had my realtor do it. And then the realtor comes back and says, well, it's been 5 days. I haven't heard from them. It's like, really? Like for me, I reach out daily until I get a response.
Well, I also think too is that you have kind of a special knowledge because we talk all the time about how this is going to affect the next one, or how a 3 unit will not make it through versus a 2 unit, and the amount of risk that we overlay in terms of trying to get a borrower to convince, not just to convince, but to basically lay out the facts for someone getting into the market. Like, these are the risks, right?
Mhm.
And because a lot about the mortgage rules, I think you're able to kind of navigate those conversations. And I feel like usually the conclusions that we come to is eventually what the borrower comes to too,
Mhm.
because because dollars and cents are pretty much hard numbers. They're not. It's you're going to come to the same conclusion depending upon what the information you have in front of you about what the risks are, what your goals are.
Yeah. I mean, what are you seeing on the mortgage side? I mean, I guess because you're working directly with a borrower, you're not really working with other loan officers. It might be kind of hard to tell, but are you seeing that the learning curve is just not there, or what's going on?
Yeah, I think a lot of it has to do with lending is not easy. I mean, if you
Right.
had to, stack the number of rules uh, and the nuances that go with, well, in this scenario, that will work or it won't work because of this question, or this person makes, an hourly job, but they've only been there for 3 months, therefore you can't use their income. You know, things like that. Those nuances, I think, takes a lot of years of experience, right? And to understand those rules, I guess makes or breaks, a good loan officer from not. I too much haven't really run into um, like really bad, scenarios, but we'll talk about the open door thing where, there is a lot of rampant miscommunications and kind of forgeries about what's realistic. So
Right.
yeah,
No, I agree. Yeah, it makes the job harder, but then the worst part is buyers and sellers don't know any better.
right.
Like I can look at a business card for a realtor, see their license number. I'm like, okay, they've had their license for about this many years. Right. So for anyone looking, if someone has a 2-2 in the beginning, it means they just got their license.
Right.
Which is fine. There's nothing wrong with that. But you're right. I mean, it seems like I tend to learn something new after every single transaction.
For sure.
Right. Because there's a lot of it you just can't learn unless you've done it. Right. I literally just had a transaction where the seller took their own life in the middle of the transaction. It's like, that's a first. And, and it was heartbreaking and all that, but we had to navigate through it. Or, I had one while back where it was a condo, the ductwork had just disintegrated inside the duct. It's like, okay, how do we handle it? How do we negotiate requests for repairs? Like, these are all new things, but you don't get that experience unless you're actually in it.
Right. And I can say on the lending side too, things always change, right? So before we had like no income doc loan, you know, no income needed whatsoever as long as you had 20% down, 3 months reserves. Halfway through an escrow was being delayed by 2 weeks. I was super afraid because the guidelines all of a sudden changed. All the non-QM people, meaning the non-regular loans, you got to hide some amount of documentation that you would normally have to disclose during a normal loan process. These types of investors have all tightened their requirements. So instead of 20% down, 3 months reserves, now they're at 30% down, 12 months reserves. So such a higher standard and trying to adjust to those kind of things.
Right. No, that makes total sense. So then, okay, what other questions do you have?
Yeah, so you have a really famous video on YouTube. It's got like 30,000 views, but once you touch on that one, just kind of give us kind of a background about the FHA 203K.
Yeah, so sorry, one thing. Yeah, so the FHA 203K program is a renovation home loan. So you can put 3.5% down of the purchase price plus the construction cost and have everything else financed. So I did it on my own personal residence. So that's the video he's referring to, some of the stuff I learned in the program, because it's not the easiest to deal with, but it is a great solution. It's a great option. And it's only for owner occupied. It's not like if you're an investor and you want to do it on another property. So then the question becomes, what are the pros of it besides just the renovation? Well, the appraisal is all based on the after repair value, and the lender will lend up to 110% of the appraised value. So even if you come up a little short on the appraisal, you still can be good. I did a major renovation on my house addition, but I also converted the garage into an accessory dwelling unit, the ADUs that you mentioned before. So these are some creative ways to make that work.
Cool. Yeah. That's is that your most famous one? Is that the one that has the most views?
Yeah. I think it's at like 16,000 views.
Oh, nice.
My average is like 100, but I'll take it. But let's take a quick look. Sort by most popular, 20,000 views.
Nice.
It's what it's at right now. So I am very happy for that video. Because there were some nuances, like things like, the lender. So the process for getting the checks cut is much slower, right? Because you have to wait for the HUD consultant to come out. The HUD consultant is someone that you pay separately to go and verify the work. You sign off on paperwork, they send it to the lender, and the lender processes the check, and the check gets mailed out. Like, we had a lot of issues with our particular lender. It was not guaranteed rate, so you're good. Where it took, one time it took 6 weeks to get the check.
Wow.
One time it took 3 weeks, over 3 weeks. Typically, it's supposed to be under 2 weeks. Mine was an anomaly. Mine wasn't supposed to be that way, but that's ultimately what happened. But yeah, it's a great program. I have a client that's doing it right now. And I think that as home prices go up and we're seeing more and more fixers come to the market. I mean, that's always been a consistent thing because, again, why sell? So somebody either had to die or someone had to, be like, look, I inherited this property, whatever, and I don't want to deal with the fixes. But first-time home buyers can't buy it because they don't have the cash to do it. Well, here's an alternative.
Gotcha. No, that's it from my side. Did you want to talk about that open door?
Yeah, so let's talk about what's going on in the news. So first of all, we'll mention Open Door. Open Door is an iBuyer, meaning they're kind of like an institutional buyer. They buy all across the country. So they'll buy the properties, may or may not do renovations, and then put it on the market. but their competitive edge is that they're going direct to the seller. They're skipping the agents, they're skipping everyone, and they're offering cash. Well, the FTC slammed them with a $62 million fine because their Open Doors claim was, we'll pay you market value. And somehow the FTC determined that they didn't pay fair market value and that basically they took advantage of all these sellers. And so that's the problem. Now, going past that, they just announced that Zillow and Opendoor are teaming up, which to me is hilarious because Zillow was another iBuyer program where they were buying homes and doing the same thing, and it failed miserably. They had to cut like 25% of their staff. So it's like, yes, let's take one company that had a failure of a record and partner up with another one that just got hit by the FTC. Like, this can't go wrong. But yeah, so that's really what's been going on in that role. And it's kind of shaken things up because, and I'd love to get your take, but a lot of realtors were spooked because here we are doing listing appointments and the seller's like, why should I go through the effort of doing showings, open houses, when here's Opendoor that's willing to offer me a deal?
Yeah, I mean, it just goes to show there's nothing new under the sun, right? As far as like loan programs coming out, there are going to be variations of basically the same thing, existing things. There's only so much risk that people are willing to take. Like, down payment assistance programs, there's no free money out there. It's just, that's not what people do. They're lending money to make money. And I think the same thing goes for real estate. The the toolbox or the process of selling a home has been the same for a very, very long time. Breaking that mold doesn't seem like it's kind of possible to me, because real estate agents have local knowledge, and local knowledge is something that you can't put into a computer screen. It's not something that you can, predict, especially because houses are so varied and buyers are so varied. I don't think you can eliminate a real estate agent from the queue and get top dollar value. A good real estate agent. Well, I mean, for example, I mean, you just had a deal where you, got a negotiated price that was way lower than the value of the property, and that goes to show that an agent can save you not only just thousands of dollars, but they can be pivotal in terms of getting top dollar.
Yeah, I agree. And then you take Opendoor, which they have their own algorithms. I don't know if the FTC really has a case. I mean, obviously they do if they're willing to hit them with a $62 million fine. But on a practical basis, what is the value of something? It's whatever a seller's willing to sell for and a buyer's willing to buy. So for them to buy these homes and the FTC is like, well, you took advantage of the seller. Like, not really, because the seller didn't have to sell to them. They made that choice. They weren't forced into it. Now, I can see where they're saying the claim of, hey, they're claiming to pay fair market value, but they actually didn't. But it's like, even then, how do you prove that? But I think it does set a precedent. Like you said, it's like, it's going to give sellers second thought of, do we sell to an iBuyer or do we actually go in the open market and see what's going on? And what does that look like? I remember when Zillow was in business, I posted my condo for them. I was just kind of curious. They actually were willing to offer me about what it would sell for. So I had tenants, so obviously I wasn't going to sell, but I was curious. And I spoke to them. But the problem is, and Opendoor has the same things, they pay a lot of fees. I think at the time, Zillow's fees were like 7%. And it's like,
Oh wow.
I can sell for less than that. So why would I sell to you? But a lot of sellers don't look at it that way. They look at what's the price I can get, not what I actually ultimately net. Right? There's that differential.
Right, right.
And so, yeah, I think Opendoor is going to be in trouble. I think as long as, sellers understand that, my guess is probably going to be a disclosure. But then it goes into the next topic, which I actually didn't give you a heads up on, but it's actually wholesalers. So for those who aren't familiar, wholesalers are people not licensed real estate agents. They go to a seller and say, hey, I want to put your house under contract for, let's say, $100,000. So you put it under contract for $100,000. Then that wholesaler will try to reassign the contract to one of their investors for, let's say, 120,000. So the wholesaler is in the middle, didn't spend a penny, and just made 20 grand. It is, my understanding, in certain states it's illegal, most states it's legal, but it'd be kind of interesting to see if the FTC ever jumps on that, because they might say, well, they're basically doing what a real estate agent does, except a real estate agent actually charges less.
Right, and the real estate is licensed too. They have to go through the wickets.
Right. Plus, wholesalers don't have any fiduciary responsibility to the seller because they're actually the buyer. What they're doing is they're saying, hey, I'm committed to buying this. Just kidding. I'm having someone else buy it. I'm going to pocket the difference.
Mhm.
So I don't necessarily have a problem with wholesaling for that very reason of like, look, whatever the buyer and seller agree on, that's fine. If the seller's pissed that they made extra money, well, then they shouldn't have sold through a wholesaler. They knew what the alternatives were.
Right. I mean that's given the case that, I think a lot of times the people that I run into just like you said, like they don't know. Like they don't know all the options. And I feel like, the American the economy in general in a democracy is based upon a level of trust, right?
Mhm.
So nothing works if we don't have a level of trust, which is kind of the amount of disclosures we have to give out are probably over 100 pages, shows the lack of trust in American institutions, right? It's
Right.
just indicative of it. So, yeah, I think you're right. Under the presumption that for sure that a seller knows all his options, right?
Right.
Because even if I give you 100 disclosures, what are the chances that someone's going to actually read through the entire thing and know they're not going to be taken advantage of? And to be honest with you, even for me, when I issue like loan estimates, we do it all the time. I had to convince them, no, there's there's no funny money going on around here. I had to just
Right.
tell them like, this is what it is. Um, there's nothing that I can hide in the law now. So you just gotta trust me on this. You could read all 100 pages if you want. Don't get me wrong, that's what they're there for. However, most people don't. I mean, that's just the reality of it.
And also on a practical basis, what are your options? You don't
Yeah, right,
sign it, you're not going to get the money.
right, exactly,
So it doesn't really matter.
right.
So okay, switching gears, the other thing that's been in the news, CNBC reported the top 5 markets of the highest like rent growth and highest rents. And out of the top 5 markets, 4 were in California. Number 1 was Los Angeles. And then number 5 was the Oxnard, Thousand Oaks, like Ventura County area. So I wanted to kind of get your thoughts on what, I don't know if you have friends that are renting or people that are renting, just what is going on. And then I'll tell you my thoughts.
Well, I think, it's just one of those things that, it's what we touched on earlier is that if rents are increasing so much and you don't get the tax benefits of owning, why are you paying someone to kind of, you're paying for someone else's mortgage, right? So it's great that those places are in high demand because all you hear is the news about how everybody's exiting California, which is kind of nuts because how do those two facts, juxtapose against one another? I don't really kind of get it. But with increased demand, there's also gentrification that goes on too, which it has its negative side, right? So normal average people are getting priced out. People who've been in those neighborhoods for 20, 30 years. It's kind of sad to see as well. So I think there's always a double-edged sword when it kind of comes to something like that. But it's not something that I think it's a train that's never going to stop, no matter how much you push against it. It's just an inevitable fact. I mean, gentrification is happening everywhere. Yeah. So like those are kind of my thoughts. What do you think, Rick?
You know, it's all about supply and demand, right? So in LA, Ventura County, San Jose was on the list. There's no more land to build. So even though generally speaking, there's a negative population growth, but it's not enough for the supply to keep up. So the question is like, why is supply so low? One, as we already mentioned, there's not enough land to build. You can't build enough. And they're not building because it could be cost prohibitive, right? It's cheaper to build in the Midwest than it is here. There's a lot of regulations with new builds. So building single family homes, requires solar panels in the state of California, which is very noble, right? Environmentally conscious, but that could be 30 grand. And
a lot of
buyers
money.
aren't necessarily paying a big enough premium for solar panels. So if you're a builder, it's like, okay, my cost just went up. Why would I build here when I can build elsewhere? And then the
Right.
other part, if you notice, because the majority of those are in California, there's either local or statewide rent control. So rent control, everyone has their own opinions, and everyone has a very strong opinion on both sides. But on the reality of it is, rent control protects tenants that are already in place. It doesn't necessarily protect future tenants. So the problem is, if you're paying grossly below market rents, kind of like people who've locked in low interest rates, there's no incentive to move. And that keeps inventory low. Then you also have the bigger issue that really the politicians aren't talking about because they don't want to admit it. But regardless of what we think about rent control, whether you're for it or against it, on a practical basis, it's actually a bad business decision, right? So if you're in the private sector, the ones who are supposed to supply this housing, they have a choice. I have a client who I've helped him buy multiple rentals. He's actually created housing in Los Angeles. He has hundreds of thousands of dollars in the bank right now, and he's choosing to invest out of state because he's like, why should I deal with rent control? And those are the reasons why inventory keeps going down, because it doesn't make sense to be such highly regulated. You still have the eviction moratorium in place here in Los Angeles. If you want to lower rents, actually, and it sounds bad, but like if you allow the evictions to happen, you're going to have these wave of new inventory. And with increased supply means lower prices.
Right. Yeah. It goes back to what we said. I mean, there's just no free money in this world.
Right.
That's just the way it is, you know. And when it's market manipulation, I don't think that's ever worked for anyone.
Well, I mean, take a look at the mortgage industry, right? When the 2008 market crashed, you had the Dodd-Frank, you had all these new regulations. And regardless of what you liked about it or not, that increased the cost of doing business for banks, right? Because they now have to hire all this additional staff to make sure they're compliant. But what does that do? I don't know last time I've seen a small bank. All these
Right.
small local banks, with the exception of credit unions, have gone because they can't afford to keep up with it. So, and I know that's a very capitalistic view, but I'm also trying to be a realist.
Yeah. Absolutely. But
So,
yeah, there's negatives to everything. I don't think there's any one great solution to it. But yeah.
totally agree. Yeah, I think the politicians, especially in Los Angeles, they're in a really tough spot because they know that some landlords are financially struggling, right? Just because you're equity rich doesn't mean you're actually rich. um, but at the same time, they know that if they allow evictions to happen, there's going to be a wave of homelessness because
Right.
many landlords are not going to accept someone with an eviction on their record.
Absolutely.
So I'm so glad I'm not in the city council's position right now because like they're going to lose no matter what they do. So, but yeah, was there anything else you wanted to discuss?
No, I think we covered it all pretty much.
Cool. Well,
Nice job, Rick.
before we sign off, tell us about your YouTube channel.
Oh,
I
it's
did not
small.
forget.
It's a work in progress. It's even the name is just John Kim. It's super generic, and there's got to be at least 6 million John Kims in the United States. So it might be even really hard to find me at all. No, but it just has some basics about lending and things like that. Questions that maybe you think are too stupid to ask, which are for first-time homebuyers. There's no such thing as a stupid question, but
Great.
I try to break it down. I try to make it as funny as possible, even though it's probably pretty dry, anyways. But yeah, with your help, I appreciate it, Rick. You kind of put the boot in me to kind of get it done. So I do appreciate it.
Of course, of course. All right. Well, if anyone wants to get a hold of you, what's the best way to do it?
Always by cell, probably 818-805-4238. I respond fastest that way, or email john.kim@rate.com. No H in the J and the John.
Perfect. If anyone wants to get a hold of me, give me a ring, 323-929-7653, or find me on the major social media platforms at Rick B. Albert. All right, John. Great job today. Thank you so much. And I'll talk to you soon.
All right, bud. You take it easy.
Take it easy.